Hi, everybody. Welcome to Trader Minutes. Great to have you aboard. And let me turn that off so you don't get any echo. Thanks for joining us for Options Education Week. And we're going to have another class right now. We're going to be talking about options usage, something that has always fascinated me ever since I learned about options. Now, if your experience is pretty similar to mine, I came to be around options or in the late 90s. But I entered the market as a day trader, and it took me a while to get into option trading because I'd have a lot of friends come in, Carl, you got to trade options. They're just awesome. And I'd look at it and I'd look at the option chains, and immediately I was like, what? Why can't I just buy this at the stock price? Why do I need all these other prices? Okay, but once I learned how to trade options, I've been hooked ever since. It's a pretty amazing thing. Now that's just the tip of the iceberg because to me, options are the most versatile trading instrument ever created. What you can do with options is just downright amazing when you stop and think about what can be done. Now, there's strategies all over the place. Verticals, you've got straddles, strangles, you've got covered calls, you've got naked options, a lot of different things you can do with options. We're going to be talking about some of those tonight. Not going to get into a lot of details. We're going to bring up spreads and stuff like that. We're not going to go out and how to trade spreads. We're going to talk about the theories and how they can work and how they can lower risk and so forth. All right. So one of the big the neat thing about that the big funds like about options is because and even some large investors, right? I know people that have quite a bit of stock in their portfolio, and one of the things that you can do with options is pretty simple. Is it's insurance. If you had a large position in Cisco, and maybe you had a large position last night or this week, and you're thinking, "Wow, I'm kind of nervous about the Cisco earnings. I better go buy some puts." Right? Well, if you look at Cisco today, and I'm just bringing this up. I'm not trying to hindsight trade here, just as an example. So let's say you're a fund manager and you had $20 million or more in a long position in Cisco, and now they're coming up on earnings, and you're a little bit worried and thinking maybe I better take out an insurance policy on this. Okay, and so you go out earlier this week and you buy a whole bunch of Cisco puts. Well, your position in Cisco is going to cost you whatever that one might be, into the millions if you're tens of millions if you're a fund manager. If you're a private individual, who knows how many shares you might own. Okay, but if you had, let's say you're a private individual and you had 1,000 shares of Cisco and you're a little bit worried about it. Okay, well you could go out and buy 10 put contracts of Cisco ahead of their earnings announcement. It's going to cost you some money, but not nearly what you would have at risk of 10,000 shares. And that's going to be your insurance policy. And if you bought that insurance policy, you're willing to lose all that money that you spent for those puts. In fact, if you did lose the money, well, fine, you recovered. Now you think about it in your life right now. You've got puts all over the place in your life, whether you know it or not. I mean, you've got life insurance, you've got automobile insurance, house insurance, life in I mean, all kinds of different type of insurance policies. My mind went blank after a few of those. But you got all these insurance policies, and you pay premiums every single month, don't you? Just in case. Just in case you had that accident, or just in case something were to happen to you. You've got some insurance there, and you pay those every single month. And if you do have that coverage, if you did get in that accident, if you did get hurt, you've got the policy there that you can collect, and they're going to help you cover all the damages and things like that, or most of them, right? Yeah, thanks, Tradehound. And it's the same thing with puts. If you're a fund manager, or if you're an investor who wants to just protect themselves. Now, I know a friend of a friend won a Lamborghini. This is just a kind of a fun example. He won a Lamborghini in a just a It was a local convenience store. They were giving away a Lamborghini. Now they ran it on for about a year, this big contest, and this guy won a Lamborghini. And basically, he already had it sold before he got it. He had it sold to a big dealership for a ton of money, brand new Lamborghini. And it's made national headlines, but when he was awarded that Lamborghini, he was smart enough. He wanted to drive it, even though he had it sold. He still wanted to drive it for the first day at least, right? So he went out and bought a one-day insurance policy for $500. He wrecked the car. He wrecked the car after driving it for, I don't know, a matter of hours. That insurance policy made it possible well, he actually made more money by wrecking it than he would have if we just would have sold it new, because he collected, and I'm just making up the numbers, it was like $148,000 from the insurance policy for a wrecked Lamborghini, which they basically totaled. Plus he collected, so he got that money for the car itself, plus another $148,000 for repairs. Very seriously, trade hand, no joke. So he actually made about $300,000. I mean, I think it was like 320. I remember what it was, where he had it sold for low 300s, and he actually, after wrecking it, from the insurance policy and from actually selling the car, made more money. Yeah, it's hilarious. A beautiful car, Lamborghini. Okay, so back to the training. So insurance is one way that you can look at options, and the way that you can use them again is incredible. Let's say you had a short position on Tesla, okay, and you're worried that Tesla's coming up earnings and they might go higher. Well, you could go out as your fund manager. You could go out and buy Tesla calls. Now, I wouldn't buy Tesla calls right now because it's probably just going to go down, but that's another example. If someone's in a long short position, they want a little bit of insurance to the upside just in case, they can go out and buy calls. And for these big fund managers and so forth, if they expire worthless, that's fine. They fulfilled their purpose. Okay, so insurance is one way that you can look at options. Another way that you can look at options, put selling. Okay, remember in options you got two options. You got calls and puts. You buy calls if you believe the stock price is going to go up. You buy puts when you think it's going to go down. But what if, I'm not going to go into details because I don't have that time in this class, but what if you went out and sold puts? Okay, you sold puts. When you sell a put, I'm not talking about making a put trade and then selling back out. I'm talking about selling a put to open a trade. Okay, and a lot of people view that, they'll call it like a naked put. There's different names for it: put selling, naked put, different usage. So now, naked puts or put selling can be, a lot of people will look at that in terms of, hey, it's like a nice covered call, but you don't have to own the stock. If you find a stock, let me think here. If you find a stock in a nice uptrend, and in your mind you're thinking, hey, this stock's going to 60. This is phenomenal. It's really moving up. So what would happen if you came down here a little ways and sold some puts, and you collected, without looking at the chains, let's say you could collect 30 cents per share, and you sold 10 contracts. You could collect a few $100s, and as long as that stock kept moving up and never came back to where you sold those puts, let's say we sold them at the $54 strike price, as long as it kept going up, we're going to keep that $300. Okay. But what if the stock comes down? Well, if we sold puts at the $54 strike price, in our mind and in our account, we were thinking, hey, if this stock pulls back to 54, I want to buy it. I'd love to buy Halliburton at 54. If that's your attitude going into a naked put trade, it's a great attitude. That way it's win-win for you. If you sold some puts here, collected whatever, $500 or more, and it keeps going higher, well, the puts are going to expire worthless. You're going to keep the money. On the other hand, so it's a win there. On the other hand, if the stock pulls back and you end up getting called out or having your puts exercised and you got to buy the stock at 54, you wanted to buy at 54 anyways. Not only that, you got an extra $500 for selling the puts initially. So a naked put trade is a great way to be able to look at trades and a great way to collect some premium on a stock that's making in a nice trend. Now, Warren Buffett doesn't really tell you the secrets, and I mean everything that he does. There's a lot of people that say he's the biggest covered call writer out there. A lot of people that say he sells more puts than anybody else out there. And Warren Buffett, if you don't know, he has two rules of trading. Okay, one of them is to make money in the market. I'm sorry. The first rule of trading is to not lose money. And the second rule of trading is not to forget rule number one. All right, not to lose money. So that guy makes money any way he can, and yeah, he's pretty successful at it, isn't he? And so naked puts is one way you can look at a nice trade like this, nice trend like that, and make some money. If it just keeps going, you're going to be fine. If it pulls back, well, you wanted the stock there anyways, so you can go out and sell puts, get a nice little premium from it, and keep the ball rolling. Now, they've made things a little bit interesting. The last few years, when I first saw them coming out, we're talking about weekly options. When I first saw weeklies coming out, first thing that went through my mind was, I don't know if I'd ever want to trade a weekly, unless given the right opportunity, maybe on a very short-term trade that I'm expecting a lot of volatility, but I don't know if I'd want to trade a lot of weeklies. That was my initial reaction, and there wasn't that many stocks that had weeklies on them. Now there's probably 400 or 500 stocks that have weeklies on them. They're becoming more and more popular. What about selling weekly options and collecting a nice weekly paycheck? Okay, so that brings a whole new way of looking and viewing options on a shorter term basis. Okay, now there's also mini options. One contract represents 100 shares for normal contracts, and I don't see a lot of minis out there right now, but the minis are one contract controls 10 shares. And there's not a lot of them out there. It hasn't really caught on yet, but they're out there. Okay. One thing I want to bring up. I'm going to bring up Options Express. And if you want to see a lot of strike prices, we talked about strike prices in my class yesterday. Go to Apple and put in all the strike prices. As far as Buffett, he doesn't trade them, he'll sell them. That's typically what he does, is sell them. Okay. That's a rumor. I don't think he makes that public, but that's what I've heard and read, that he'll sell options, sell calls, sell puts, and things like that. But as far as trading them, not really. Yeah, Apple. Been one of my stocks that I've been selling puts. Yeah, Steve, if you go into the right attitude of wanting to buy the stock at the level you're selling the puts, it's almost a win-win, because you wanted to buy it at that level anyways. But you're right, if you don't get out when you should, there's a lot of risk with those. And I had a friend. Now I better keep going here. I got a lot of stories, but so here's the option chains off Apple, and they're huge. And I just want to point this out, okay? Because one of the things as option traders, when you get used to the chains and everything, one of the things that a lot of people will do is they'll look at the open interest, and the open interest is this column right here, and they'll look at the volumes, and in their mind they're starting to do some math. They're starting to think, wow, look at all these thousands, 4, 3, all of threes, 5, 7,000. And then they come over here and they see, all right, well, out of the money here, there's a few in the money, a few thousands out of the money, and they're trying to weigh in their minds whether or not to be bullish or bearish. Doesn't really work. You know me, if you've been around TraderMint for a while, I'm a chartist. I love the technicals. I let that tell me what's going to go on. I want to decide for myself what's going to go on, because over here, these puts, all these put action right here, way out of the money like this. Over here, way out of the money, all the call actions. That could be anything. It could be some people out here gambling, way out here at the 400s. It could be a lot of these are strategies like vertical spreads and so forth that we'll touch on lightly today, and condors, to where they're making money and they really don't want the stock to get up there or down there. So you don't know what these are. When I look at these chains, I'll look at them and I'll say, all right, well, and just is just for fun. I mean, I look at these and say, all right, if there's two numbers, and they're not exact, but look at this number right here, and look at this number right here, and even this one right here. Those, see how close those are? To me, that's somebody out there doing a spread. They're buying and selling options at these prices. It's one big investor, about 1,000 contracts or so, and he's buying some, he's selling some. I look at stuff like that. Now we don't know. It could just be, it just happened, circumstance. It just happened to look alike. So you don't know for sure. But to me, that looks like someone's lined up a nice little spread trade, and they're going to collect a little bit of money there. And based on the number of contracts there and what they'd be making, it would take quite a bit of there for that. And so I'll look at things like that, but it's still not going to point me in the direction. These people are hoping Apple doesn't pull back on them. They want to go way out of the money like that because they're expecting it just to keep going. If it does pull back on them, they could be upside down pretty fast. All right, Apple's got some momentum right now, and same out here. I mean, way out here, 560s, 570s, the 600s. And you can keep going down this list. And I'll look around, I'll see, well, there's two numbers that are fairly close, and if there is, and there's not always, but it's a lot of times it's just spread traders. And they're not, what they're doing is collecting a nice little premium and just hope the stock doesn't get up there. Or in some of the spreads, you want it to get up there. Okay, there's the different types of spreads that you're going to be looking at. Okay. And so don't look at the open interest in the volumes and think that, well, there's a lot more puts going on here today. Apple's going down. Because that's not likely the case. Okay. Another thing, and I did a little bit of training on this earlier in the week, but it wasn't for one of these classes. And this is one of the things, and when I've seen a lot of educational programs over the years. I've been a coach for 8 years. In the markets, it's something that I really have a passion about is teaching and trading, and so I mean I found a dream job for me where I can teach and trade and do all the things that I really enjoy. And one of the things that kind of a pet peeve is when advertising, right? And you get the marketers, and how do they get your attention? Is they want to show you some new and exciting things and ways that you make it that make it so you can almost win money in both directions. Okay, and talking about what they call a straddle or a strangle trade. Now let's look at a different stock. I'm going to pull up Cisco. I'm laughing because, well, if you saw Cisco today. Now Cisco had some pretty big warnings in their earnings announcement about growth, future growth in the coming quarters. And they gapped down big today. And so in these trading programs, they're saying, they're advertising, they're going to say you can make money whether the stock goes up or down. And they're going to call it a straddle, and some of them are going to be making up their own deal. You're right, Tradehound. You're exactly right. And so they make it look like, geez, I can make money. All I can do is buy a call and I can buy a put. If the stock goes up, I'll make money in the calls. If it goes down, I'll make money in the puts. That's fantastic. Okay, it doesn't work like that, right? It's great marketing, and people that haven't been in the market might look at that and think that's incredible. I got to learn about that. All right, so I always poke holes in that because there's so many things. One of the big things that's going to affect a straddle trade is buying calls and puts is the volatility, and that takes it to another level of depth when you got to look at the volatility. Because like today on Cisco, if you did have a straddle on it, that volatility skyrocketed on you, and you made some pretty good money on those puts and didn't lose quite as much in the calls. Okay, but an understanding of that's a completely different level of just saying buying a call and buying a put. Okay, so but a straddle, yeah, buy calls, buy puts, same time, same strike price, but you need that stock to make a big move. If this thing gapped up slightly or gapped down slightly today, you would have lost money in the calls and the puts, and you wondered what the heck happened. It's not going to work. There's not a foolproof strategy in the marketplace. Okay, now one of my favorite things to talk about, and it's on the list, and this is one of those trades that can also be seen like just a pure win-win for you. Okay? And when I like to talk about covered calls, and there's weekly's brought another dimension to covered calls for me. It's not one of the more exciting things to do as far as covered calls. And Jeff said, Jeff goes to sleep when I mention covered calls. And but covered calls is a great strategy. What if you had 10,000 shares of Cisco and you decided, hey, I'm going to rent my stock out for a while. So if you bought an apartment building, of course you want property values to go up over time, but hey, why not rent it out and get a monthly income? It's kind of the same thing for a covered call. If you buy a bunch of stock, you can turn around and sell calls to someone else for the right to buy your stock. Now let's say Cisco here, let's go to their chains. Now with covered calls, I like to go shorter term. I mean, not like sell them today and reap the rewards tomorrow. But if I were going to do a monthly covered call, I would be next month calls, unless the month just starting, right? And I could come out here and I can look at Cisco. Let's say I owned a bunch of shares at 20, 21, somewhere in that ballpark, right up through this range here. And I come out here to 22, and I see, well, if I sell some calls here, I can collect. Let me bring that in. So we own the stock. Let's say we bought again, right? At 19 or 20. We bought the stock there. And in our mind, we're saying, hey, if this gets to 22, I'd be fine with selling it. Okay? Because you do. If it gets to 22 and that's where you sold the calls, then that's where you got to sell your stock. Pushing the wrong button there. Okay, so I can look here, and I bought the stock, let's just say 20. It's a nice round number. I bought the stock at 20. And right now, I can collect 24 cents per share for selling these calls. Right? 24 cents. Remember, you always sell options at the bid price. I can get 24 cents. So how much of a percentage is that? Well, if I bought it at 20, 10% would be $2. It'd be about 1%. So is it worth it for me to put my stock on the line to get 1%? No. I can get $240. I got 20,000 on the line. Probably not. So I can look at other stocks and try to find one that's going to pay me 3 to 5%, and you can find them. Okay, but what if I looked at the weeklies? Now here's November week 4 calls, which is next Friday. So again, I bought the stock here at 20. Let me zoom in on this. Oh, I got to go out, get rid of that. I buy the stock at 20. Oh, I get these buttons. I got to get them right. Buy them at 20. And right now, at the 21.5s, see the stock price, so just higher than where the stock price currently is, 21.36, I could sell these and get 20 cents. That's 1%, just about, in less than a week. I mean, just over a week. So I can either go out and get 1% a month, or I can get 1% in a week. The thing about weekly options as well is, well, you get a weekly paycheck. Okay? You're also exposed to the stock and to the market for a shorter period of time than a whole month. And if we think this market might be nearing a top, and who knows when the runaway freight train's going to stop, but a weekly options are going to leave you less at risk to where you could jump out if it did turn against you. And so I can get 20 cents. All right, so that's great. If it goes up above 21.5, then I'm going to get called out, which means I have to sell my stock at 21.50 and move on. And so I would have made $1.50 on the trade. If I got in at 20, I made $1.50. If I had 1,000 shares, it's $1,500 plus who knows how many weeks in a row I was selling these calls along the way every single week. And I'm getting 1% in a week. Now think about it, 1% in a week, that would be a couple $100 if you had 1,000 shares here, a couple $100 a week. Okay, look at the long-term picture. 1% a week is over 50% a year. 50% a year. I mean, where are you going to get that kind of money? It's kind of, yeah, as option traders, we like to get 30, 50, 100% in trades. So we're looking at 1% a week, but this is a much more conservative style of investing. There's not, Tom. There's not. When you see the volume, you don't know if that's buying or selling. You don't know. Okay. I mean, I've never done this, but you could write down the open interest and then start tracking it the next day and the next day and see if it grows or if it goes down. But still, bottom line, you don't know if there's a big influx buying in and there's a bunch of people selling out. It's never going to give you the true picture as far as just as looking at the volume. The important number there is the open interest. The contracts, the number of contracts that investors are still holding on to, they haven't sold yet. Okay, that's the important number, but again, it's not one of these things that you compare the calls and the puts to determine which way, the bias of which way most people think the trade's going, because the stock could be in an uptrend and you can see all kinds of put buying going on, but it doesn't mean people are going out and wanting to short the stock and buying puts that way. They could just be selling puts. Okay. So covered calls, it's a phenomenal strategy. It's a fun one to teach, but it has its drawbacks too. What if you got into, you're welcome, Tom. What if we got into a trade here at 20? What if we get into a trade here at 20 and we sell the $21 calls, or we sell at the 2050s, and I'm talking hindsight here. So when we bought into this trade, it was at $20 a share, and we're looking out 50 cents a dollar, deciding where we want to sell the calls. But what if the stock all of a sudden starts going down? Then what do? You got some calls sold out here. So yeah, you've got you got a little bit of money there. Let's say we collected $300 for selling some calls. So we got a $300 cushion below the stock, but if the stock drops down $1 and we have 1,000 shares, we just lost 1,000. We made 300. So we lost about 700 on the trade. You sell the calls again the next month and it still goes down, it's putting you further and further in the hole. And as it drops further and further, then becomes the problem. Okay, so now let's say we sold at the 20 there. Let's say the stock is bought here at 20. Let's say the stock's now down here at 18. You bought it at 20, and you're thinking, well, I can sell the 18.5s, but if you sell the 18.5s, you get called out. You just lost $1.50 because you bought in at 20. Okay, and so there's a lot of variables. I taught a guy once, these covered calls, just did phenomenal. He was making 3-5% a month, loving it. And then he got into a trade and it started going against him, and he ran into this problem. He had never thought of that before. Well, what if the stock goes against me, and now I got to sell the calls, but where I got to sell them for is not where I'd like to sell the stock. So you got that, okay. But covered calls is a great little strategy, very conservative strategy. You're not going to see us use that any type of a challenge trade or any trades that we throw out here. We've got some ideas down the road when we start to grow a lot of what we could do, but you won't see us do covered calls. We'll talk about them. We can train about covered calls here. They're fun to talk about. I think they're great trades, but you won't see us making those trades. Right, Doc Trumps. Yeah, you buy the stock at 69. Qualcomm jumps $3, $2-3 over that. And all the upside you're going to get is up there to 70. Okay, but that's one of these things with covered calls. I taught this to a guy once, and he went out and made a trade, and the stock got some news like a week later, and it jumped $8 on him. And he had about about $1 worth of that is what he captured. And I told him, what did you make on the trade? And it was like 15. I mean, it was like 13% is what he made on the trade. And said, be happy with it. You got 13%. You're going to get called out. Just be happy with it. And that's the way you got to look at covered calls. If it does gap higher, well, there was that risk, and you capped your upside, but you're going to get a little bit bigger percentage. Okay. Yeah, Rubik's cubes. Yeah. All right. Now there's also vertical spreads. All right. So let's say, well, it does not pull up Cisco. Let's go Netflix. Well, I'd like a little bit more of it's kind of a side trending stock for this, and it's kind of been the last little while here. But let's say that and what the thing about these higher price stocks is you can go a little bit further out of the money when you do vertical spreads, and you can do what they call an iron condor or a condor. I'm sure people have made up their own names for condors, but it's basically when you're straddling both sides of the trade. You're expecting the stock to go sideways, so you go up into wherever that might be, 370, wherever that range is. You want to try to get about 50 cents, 30 to 50 cents on each side of this. So we could sell calls and buy calls at a higher price and sell puts and buy puts at a lower price. And really all you want to do is let this stock go, just kind of sideways. It can go up a little bit, it can go down a little bit, and as long as that stays within that range, and let me back out just a hair. I'm just throwing numbers out here. Let's say we sold at the 365s and bought at the 370s, or down here about in this range, just the exact opposite with the puts. So what in your mind, you're thinking, all right, I just want this stock to kind of go up a little bit, kind of go down a little bit, as long as it doesn't come to 320, as long as it doesn't come up here into the 370 range, I'm going to make money on both sides of this trade. Okay. And that can happen. You don't want the stock to do that. These trades I don't like them. To set these trades up, you're making 4 trades. 4. If your brokerage is charging you $10 a shot, they're charging you $40 to get into one trade. If it's Options Express, they're charging just $60 to get into one trade. They love these trades because they're making a ton of money off of you. I'm not a big fan of them. You also got the vertical spreads that you could go way below, right? The debit spreads, where you can come and go way out of the money, collect a nice little premium, and you just don't want the stock come back to the level where you sold your options. Okay. Now, we can give some trainings on vertical spreads and debit spreads, credit spreads, and things like that in the future. Just wanted to keep this a high-level class tonight, and the different things that you can do with options. And to me, it's pretty amazing. There's all kinds of books about it. One of the pioneers of options trading was John Najarian. He's got some good books on it. And there's a lot of other books about spread trading, things like that. Just read it, learn it, virtual trade it, see if it's for you. Okay, but I appreciate you attending this class tonight. If you have any questions or anything, I'll be on just for a few minutes here with you tonight, and then we'll catch you in the next class. Now, the next class is going to be tomorrow morning at 11 o'clock Eastern Time as we kick off the new challenge. We'll be on first thing in the morning before the market opens as usual, kicking off the new challenge, be looking for a trade, and then it'll be on a little bit later, given the last class for Education Week. Okay, thanks for being here tonight, everybody. Have a great evening. This class will be recorded. You'll find it up there underneath Options Education Week a little bit later on tonight. Thanks. Take care, everybody. You too, Tom. Bye-bye.